You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
But I also think that I think the bulk of the washout in the precious metals sector has already happened. And you can sort of see it if you look at charts.
Thanks for tuning in to Mining Stock Education. I'm your host, Bill Powers. And in this episode, we're going to hear from Dave Kranzler of InvestmentResearchDynamics.com. Don't forget, he's the editor of the Mining Stock Journal and the co-producer of the Mining Stock Daily podcast. Dave, welcome back onto the program.
Bill, thanks for having me on again. Always love doing your show.
And we always love having you. And I know a large segment of my audience always appreciates the mining stock picks that you so generously share on my show. But we'll get to that at the end of this conversation. Let's start off with getting your kind of macro view as it relates to gold and the economy. Energy prices are soaring. Us gold investors, sentiment is in the toilet. What's your analysis of what's going on and what key indicators are you looking at?
Sure. So there's been a high degree of agitation and negative sentiment, probably because this latest down leg that we've had in the sector it started probably at the end of March, early April, and they really started taking the price of gold down in the paper gold market, right? I mean, we have to differentiate between the physical gold market and the paper gold market. The physical gold market is largely based in Asia. And it's concentrated around countries like China and Russia and India. And when they buy gold, they're buying physical gold that has to be delivered into the country. So it has to leave London vaults and either go directly to those countries or leave London vaults and go to Swiss refineries, get refined down into kilobars that the Indians and the Chinese prefer, and then ship to those countries. So, and that's the physical gold market. Then you shift to the West, which is no longer, the COMEX was never a physical metal exchange. It's always been a paper derivative exchange. And the LBMA, I mean, there is a physical aspect to it, but as you've read extensively, especially in the last year, and as your audience has read extensively, I mean, it's largely what's known as an unallocated gold market, right? I mean, let's just say, for instance, an Eastern European central bank buys gold and they decide to leave it in London vaults, the bars in the London vaults, right? So there's an accounting entry that's made that says, okay, this is Uzbekistan's gold, right? But those bars get hypothecated and you could have another central bank, Brazil, that buys gold. They bought gold bars recently, and I still haven't had the question answered for me satisfactorily as to whether they had those bars repatriated or if they left them in London vaults. But they could, for accounting purposes, they could be allocated the same bars that were allocated to Uzbekistan, and no one would know the difference, right? So that's a real simplistic version of how the unallocated gold system works. Well, if you go back, you can go back longer than April, but especially since April, if you look at 24-hour charts of gold and silver, and I do that every day, almost all day long, and you'll notice that what happens is it's a common pattern. I'd say 80 to 90% of the time, where the price of gold will rise late in the evening in U.S. time, in our time zone. It'll rise up until about midnight or 1 o'clock or 2 a.m. And I'm using Mountain Standard Time, Eastern Standard Time. Because that's what the gold chart I use, the futures chart I use is Eastern Standard Time. And then all of a sudden it'll maybe, top out, and then all of a sudden it gets hit. Well, what happens at 2 a.m. East Coast time? Basically, India and China shut down for the day, right? Because it's evening over there now, or late afternoon, so their markets close. And what happens is essentially the paper gold market takes over, and all of a sudden, there's plenty of COMEX contracts that are offered for sale in the Globex system. There's plenty of LBMA forwards that are offered for sale over in London, and that's kind of how it works. And the same thing happens if you go and look at say 8:20 to 8:30 every morning, and that's when the COMEX floor hours open. Again, you'll see another leg down in the price of gold 80%, 90% of the time. That's the paper market driving down the price of gold. And so what I think a big part of this latest takedown in the price of gold, and just one overt example of this was August 8th, when, like you're probably like me, I was actually on the tennis court at the time, but, around 4:30 Denver time or, 6:30 your time, you log in and you see what's, because the futures are open, right? So you want to see what gold and silver are doing, see what the dollar's doing. And that particular night, that afternoon, the price of gold went straight off a cliff, almost $100. Do you remember that?
Yeah, definitely.
And it bottomed at 1680, and then it bounced. But that was not physical gold changing hands. That was all in the paper market. There's no physical gold that trades anywhere at 6:30 p.m. New York time. And so that was a paper price hit. And if you're a hedge fund and you're long a big chunk of gold contracts, and you decide you want to move out of them for whatever reason, you're not going to dump them all at 6:30 p.m. New York time on Sunday night. That's the least liquid period of the market. So that was an entity, and I think we all know who that is, who was motivated to bang down the price of gold and I think the motive for that is to defuse the signal that gold sends on both inflation and financial systemic risk. What I'm referring here to is, and I wrote about this extensively in the intro to this week's Mining Stock Journal that went out yesterday afternoon to my subscribers. So this is kind of a sneak peek of the analysis that I had in there. Is I would argue that there's a massive financial system crisis building. And Evergrande is a small part of the cause, but it may have been the black swan trigger, right? I mean, you can't really point to a specific black swan trigger in 2008. We knew everyone knew Bear Stearns was going to blow up except Jim Cramer. I mean, I shorted Bear Stearns, or I bought puts on Bear Stearns when the stock was at 60. And by the end of that week, the stock was at $2. It was obvious. It was obvious Lehman was going to blow up, right? And Lehman blew up. And then you had the Goldman Sachs AIG debacle, where AIG defaulted on who knows how much notional value of credit default swaps, but they couldn't honor the credit default swaps were triggered. And GM was Goldman Sachs was staring into the abyss. And the Fed had to create a specific facility just to monetize AIG's liabilities. Evergrande may have just been the black swan trigger. I mean, there's been, we've seen tremors, Archegos, Greensill blew up, Archegos blew up. There's probably been some blowups that have been monetized quietly that we're not aware of. And so I believe the move in the dollar, because the dollar's gone up quite a bit since early August. And that's really when the Evergrande tremors really started rumbling. I would say the move in the dollar is a flight to safety, because even though the dollar is what it is, and it's being de-emphasized, especially by Eastern Hemisphere trading companies, it's still used as the most liquid market in the world, the U.S. dollar market, and it's still used as a flight to safety by those who can kind of sense what's going on, or maybe they have front row seat and can see things going on behind the scenes in the financial system that most of the market can't. And so I would argue that, and we've seen this, we've had corrections like this in the gold market several times over the last 20 years. 2006, there was an ugly correction in the market. Obviously 2008, from March 2008 to the end of October 2008, gold was dismantled, and silver was taken from, I think it hit a high of 20 or 21, and it was taken all the way down to 7, if you recall. And it was done because the central banks didn't want gold and silver to go parabolic with all these things like Bear Stearns and Lehman happening and cause a panic. And then money printing, and gold and silver, shot back up. We saw the same thing in February, March 2020. Gold and silver were annihilated. I mean, silver was gold was taken down almost to 1,200, and I forget how low silver got, but it was
like 1164, I think, Dave. I think it was 1164, if I recall correctly.
I think you're right.
Yeah.
I think you're right. And it was during the heat of a crisis when you'd say, "Oh, shouldn't gold and silver be flight to safety vehicles?" Well, boom! All of a sudden, the Fed drops $3 trillion into the monetary system, and gold and silver are off to the races. So, I guess my point here is there's been a pattern over the last 20 years when we've had these massive corrections in gold and silver. It's usually preceded some type of crisis that requires the central banks to monetize the crap out of the financial system. And I think we're going to see that again. I know you mentioned that Kiyosaki said October is when the fireworks start. Well, I learned a long time ago not to put time frames on when this stuff blows up. But I would say maybe sometime in the next 6 to 9 months, we may see the reason why gold and silver have been abused like this in the paper market. And I think gold and silver will be a lot higher by then.
Dave, remind us of the domino effect back in 2008, from Bear Stearns to when it really impacted Main Street. What was that time frame?
That was, Bear Stearns, we kind of knew in March that year, I believe, that it was on the ropes. And that's when gold, I remember, because I was in a ski condominium up in Crested Butte, and I was trading gold futures in the morning. And I think I remember gold hit like 1,200 or something, maybe even higher. I don't remember the exact price. And then all of a sudden it started heading south. And I was like, what the heck? And you would think that with Bear Stearns becoming more evident, you would have thought, gold and silver should be going up. No, well, they were going down. And that's kind of, so you had Bear Stearns, and then Lehman, a good friend of mine, a longtime friend of mine, worked at Lehman back then. And employees knew in March and April back then that Lehman was on the ropes and was eventually going to blow up. And I think the market kind of sensed it. And then, so you basically went through the summer, and then Lehman blows up, and then the brown stuff hits the fan, and Goldman Sachs would not be in business today, I believe, if it wasn't set up for Henry Paulson to be Treasury Secretary. And there's documents like he was on the phone several times a day, all day long, with the then CEO of Goldman Sachs. I think it was Blankfein. And recall, Paulson was the former CEO of Goldman Sachs, and he was given the Treasury post after he stepped down. And ironically, he still had $250 million worth of warrants on Goldman Sachs stock. So for him, he's going to do what he can to keep Goldman liquid. So that was kind of the sequence of events. Gold's taken down from 1,200 down to 700. And then all of a sudden, Bernanke starts saying we're going to start doing creative things with monetary policy, and boom, gold and silver take off. The Huey index back then, intraday, it bottomed at 145, and I think the low close was 150 or 152. And in early October, or early November, that was when it bottomed, and by the end of the year, it had doubled, went from 150 to 300. And I think that type of scenario could possibly play out again.
We'll be right back after this word from our sponsor. Silver One Resources is an exploration and development company backed by strategic investors Eric Sprott and SSR Mining. At Silver One's Candelaria Mine project in Nevada, there is already a historic resource estimated at 127 million ounces of silver, which Silver One is developing and advancing. The company's Phoenix Silver project, located within the Arizona Silver Belt, is an early-stage exploration project on which native silver vein fragments have been discovered near surface. One grab sample assayed an astounding 14,688 ounces per ton. Yes, that's right, ounces, not grams. Silver One has tremendous exploration potential, is extremely leveraged to the price of silver, and is cashed up and poised to increase shareholder value. Silver One trades in New York under the ticker SLVRF and in Toronto under the ticker SVE. To learn more, go to silverone.com. That's silverone.com.
So gold could track down if there is this crash. You could even see gold tracking down again. Because I think in the past you've told me over the years that You don't know for sure, but it could be that gold goes up, right? If everything falls apart.
Look what happened on Monday. Monday, last Monday, a week ago Monday, stock market was getting annihilated and gold was right. Gold went up. The mining stocks were green a week ago Monday, for part of the day. I mean, they ended up closing down a little bit, but they way outperformed the stock market. If we get, we get a market, and I think we will see a market crash like we saw in February, March 2020. If we get that kind of market again, I mean, it could take everything with it for a while because you're going to have hedge funds that are dumping like crazy. But I also think that I think the bulk of the washout in the precious metals sector has already happened. And you can sort of see it if you look at charts. I mean, that the 1680 bottom or 1685 bottom on August 8th, if you go back and you look at it, and I did this yesterday, if you look at an intraday chart and take it back to the beginning of the summer, I mean, you can, or actually back to maybe even a little further than that. I forget how far back I took it, but you can see there's been that 1680 level's been tested several times over the last several months on a very short basis. But there, the price of gold is still it's in a nice uptrend. I think there's a chance that we hit like 1720 or 1722. It was either last week or early this week. And if you like to look at charts, it looks like it's a support level. And we bounced off of that and we're much higher now. So, does that mean it's gold and silver aren't going to go lower? Well, no. I mean, they easily could if the market takes a big dump. But I also think that, I'm saving cash for that event. I'm not all in the market right now because I'm worried about something like that happening.
Dave, what about energy prices? I've already prepped my wife, said, get ready for some high natural gas bills here with the Michigan winter coming. What's your analysis of oil and natural gas headed to the moon?
I think if they try to use the cover story that it's supply chain disruptions, that's a bunch of BS. I think it's more directly related to the currency devaluation that's gone on around the world, especially since March 2020, and the Fed being the worst offender. And you've had just a massive amount of dollars, euros, yuan that have been printed, right, to keep the various financial systems from blowing up. And that creates currency devaluation. And oil, even though it doesn't trade, not all oil trades in dollars anymore. In fact, a large portion of oil does not trade in dollars. It settles in rubles and yuan and various other currencies. But it's still a dollar. It's still called the petrodollar, and it's still, the bulk of oil transactions are settled in dollars. And so if you're an oil producer and you see the dollar being devalued like that, aren't you going to want a higher price for your product? Right? Because at $60 a barrel, that dollar is not, if oil is at $60 a barrel now, which it's higher, I know that, but if you're sitting there at $60 a barrel a year after March 2020, you're saying to yourself, wait a minute, there's a lot more dollars washing around the world. So the $60 I'm getting for this barrel of oil is not the same as the $60 I was getting for that barrel of oil in January 2020, right? Before the Fed dumped $3 trillion into the system and more since then. They basically doubled the balance sheet, more than doubled. So I would argue that as with all the higher prices that we're seeing, sure, there's some supply chain considerations, and I actually think a lot of that's seated in price inflation. The higher prices we're seeing for everything is a function of currency devaluation. More dollars, more euros, more yuan chasing, the same amount of goods that are being produced, basically, right? So, and that's what drives the price up.
Even though the dollar index is up, someone might object and say, "Well, the dollar's at 94." So,
if you look at a chart of the dollar, being at 94 is really not that consequential. It's pretty insignificant. I mean, I can pull one up here. If you take the dollar chart and go back 25, 30 years, 94 is like at the low end. So, I think there's a chance that energy prices are going to continue to move higher. They may go parabolic at some point. I mean, we saw the announcement that China had yesterday, right? They're telling their energy companies to buy as much energy as they can and don't worry about the price. Pay what you have to buy as much as you can.
If they go parabolic like the late 70s, gold and silver goes with it then?
I think if you look at the dollar index just over, so this chart takes me back to 1998. I mean, the dollar index, averaged, well above 100 over the last, 23 years. If you take this chart back even further, it's averaged well above 94. 94 is still relatively at the low end. And again, it's the lower level of the dollar relative to the last 30, 40 years is a function of all the money that's been printed, all of the dollars that have been printed. So I think if energy prices continue to do what they're doing, and at some point they may go parabolic, there's some analysts who are saying that, you're going to see gold and silver go parabolic times 2 or 3. Because if energy is 50% of the cost of mining, and if the price of energy goes up like that, these mines will just shut down. They'll just shutter production because they're not going to sell the gold and silver they produce at a loss. And that'll take away the supply of physical gold that I think, and I think that would disrupt, I think that would smash the paper gold market, the paper derivative, unallocated gold market, if that happens. Because India and China and Russia, et cetera, they're still going to buy physical gold, whether it's going to cost them $1,800 an ounce or $2,800 an ounce. They're going to buy gold. That's what they do. It's in their DNA. So the other thing that's interesting is I had lunch with a junior mining company CEO about a month ago. And this guy's super bright. He's a geologist. He also has a degree in mine economics from School of Mines. And he said that if you look at the price of gold over a very long period of time, the price of gold it stays at a pretty constant rate above the all-in cost of mining, right? So if the price of gold goes below the all-in cost of mining, because of energy, you're either going to have to see the price of gold rise, get back above the cost of all-in cost of mining, including the cost of energy, or they'll shutter production until the price does rise like that. So, I mean, that's one of the most major bullish factors driving the price of gold is price inflation, and the effort that we've seen to push down the price of gold is an effort to try and kind of unplug the message, the alarm that gold would send when there's rising, quickly rising inflation, and also escalating financial system problems. The price of, technically, I think the sector's washed out. And there's an indicator called the Holbert Gold stock newsletter, or Holbert Gold sentiment newsletter sentiment index, HGNSI. And when that thing goes negative, it means that sentiment in the sector is really bad. And when it goes really negative, it means the sector is getting ready to wash out. So a couple of days ago, that sentiment index hit like minus 54 or something. And it was a lower reading on that. It was a lower reading on that index than 99.4% of all readings going back to the year 2000. And historically, when
except late 2015, early 2016, how does it compare to late 2015?
I think it actually hit the negative 50s probably in 2013, 2012. If you remember, we had there was one day, I think it was 2013, where gold was down $200 in a day. I don't know if you remember that. In fact, the guy I had lunch with a month ago, he was over at a conference in Zurich, and he said the big talk was that, you know, they all knew that it was a paper market price ambush, and that Goldman Sachs and JP Morgan had massive put positions on gold futures. So that's just another example of how manipulated this market can be. But there's times when they can't manipulate it, and otherwise the price of gold would still be at 250 where it was when I started back in early 2001, right?
And silver was at $5, I believe you told me, right? You loaded up at $5.
No, I remember seeing silver trade with a high 3 handle on it a couple times.
Well, you can't even get premiums at $3 sometimes nowadays.
Oh, I know it. So anyway, the HGNSI sentiment indicators completely washed out. It means we're going to have a rally here at some point. I mean, it may have started. That doesn't mean that the rally's, you know, it's the start of the big move. It could be, it might not be. I mean, what's been happening, you know, over the last few years, really since the end of 2015, is that when the sector starts to get some upward momentum, all of a sudden huge speculators pile in, and it's short-term money, and it drives the sector up really quickly. And then the sentiment indicators get overblown and the technicals get overbought. And it's, to me, that's not a high quality rally. A high quality move that I think we will see a high quality move. And by that, I mean, you know, an extended period of time, 18 to 24 months of rising prices, like we saw from 2008 to late 2011, right? So that was for gold. Silver was a little bit shorter, but for gold, it was a 3-year rally, 3-year move in the sector. And fortunes were made during that period. And I think we will get another move like that. And part of it will be predicated on whether people have been scared off enough to stay away from the sector, you know, for long enough and not pile in when it starts to move higher again.
And when they do get excited about gold, they look to the mining stocks. So maybe give us a couple leads on what you've been looking at, if you don't mind.
The real speculators look to the junior mining stocks.
Like you and me, we don't buy those big, well-capitalized majors. We go for the $5 to $30 million market caps, right?
A colleague of mine asked me, you know, the other day, hey, what do you make of the Agnico Kirkland Lake merger? And I was like, I mean, I read the Market Watch news release. I haven't really studied it. It's like, I don't know. It's, you know, built the 3rd largest miner in the world. You know, I can't even tell you what Agnico's cost structure is. I don't care, because, you know, if Agnico goes up 50%, it means the stocks that I look at and invest in are going to go up 500%, right? I don't want to waste my time with Agnico. Now, that said, I do, one strategy I do is when we get really washed out like we are right now, I'll pick a few large cap producers, and I'll buy deep in the money, long dated calls. And I look for calls that are, when I say long dated, I mean 2 or 3 months out, because I don't want to pay too much time premium. What I'm trying to do is replicate buying the stock with in the money calls, so that, you know, if you've got, I don't know, where's Agnico right now? 51, right? So if I look at, say, and I don't know if December is an option month for Agnico, because I haven't looked at this yet. But if I look at, you know, say December 40s, right, and the stock's at 51.43, I want to try and find in the money calls where I'm only paying 20 or 30 cents of time premium. So the cost of the call is plus the strike price is only 20 or 30 cents above where the stock's trading. You see what I'm saying? Because if I get a $5 or $6 move in Agnico before, or $10 move even, which is highly possible, before that option expires, I'm going to get junior stock like rates of return on the capital that I put into Agnico. And I should have looked at it so I could give you a specific numerical example, but so that's what I do with the large cap miners. And Fortuna is one. I think that's a stock that incorrectly got the crap beat out of it when it announced the merger with Rockgold. I don't think the market understands it. I think a lot of silver bugs fled out of Fortuna stock because, oh no, they're diluting their silver value with this gold. Well, if you bother taking a look at the mines that Roxgold has over in or the mine plus the projects that it has over in West Africa, some of the highest grade gold mines, in the world right now. So, and so if you've got a gold mine that has, is producing 8 grams a ton gold, I mean, that gives you a lot of leverage on the price of gold. And they just made a construction decision on a second project over there, the Seguela project, and it's probably going to be up and running by mid-2023. And the grades on that project are just ridiculous. And so, I mean, Fortuna, if you include the eventual production from Seguela, it's not going to be running up, let's say it does 130 ounces of gold a year, 130,000 ounces of gold a year, by the start of 2024. Fortuna is going to be producing, somewhere between 450,000 and 500,000 ounces of gold equivalent. And that includes their silver. So right now they're doing, between 6.5 and 7.5 million ounces of silver a year. And they've got a high grade gold mine in Argentina. They've got one high grade gold mine in West Africa. Soon they're going to have a second high grade gold mine. They've also got a project over there that looks like it could be, in and of itself, if it was just a junior developing it, it'd be a company maker, the Basura gold project. It looks like it could be extraordinarily high grade gold, open pit and underground. So there's Fortuna has also got 5 projects in South America and Mexico. I think it's 3 in South America and 2 in Mexico. These are greenfield projects. So there's junior upside optionality embedded in Fortuna. Plus you've got, a mid-level, a mid-tier gold producer. So Alamos produces, somewhere between 470 and 500,000 ounces of gold. It's got a $3 billion market cap. Fortuna's market cap right now is 1.2 billion. So the way that I do relative value, Fortuna is really cheap to Alamos. And so that's another stock that I've bought a large amount of November or December and January 4 strike call options. And I bought them when the stock was trading around 430, 440, and the stock's now back down to 4. It went below 4 the other day, but I held them. So that's kind of how I talk about taking advantage of the large cap miners in my mining stock journal.
Maybe one junior pick could you give us before we go here?
Sure. I'll give you 2.
Okay.
You get the bonus. Heliostar. I don't know if you follow Heliostar.
No, but you did bring it up to me on a previous show. I remember Heliostar.
Yes.
They had the project in Alaska.
Stock price is, they've got a project in Alaska, a very high grade gold project.
And one in Mexico, you said?
Well, they've got 3 separate silver projects down in Mexico. And one of them, Silvercrest Metals, approached him about JVing on, and the CEO told me, he said, no, thanks. I have a gut feeling on what's there, and I want to get 100% of the economics of that for my company. And they released assays from trenching that they did on 3 known veins that are on the property. The veins actually happen to flow from a historic mine that Silvercrest Metals owns right next to this project. So Silvercrest probably kind of knows what's there too. And they had, like, I mean, it was just ridiculous grades of near surface gold in these assays. And they have to drill it to prove that gold goes further underground and that these veins are for real. But I mean, the current market cap on Heliostar is, I don't know, about 22 million US. And the CEO told me that he thinks that just based on these assay results that they produce from this property, and this is just gold on the property. There's also going to be silver on the property. He said that he thinks he could probably sell the project outright for between $5 and $10 million. You're looking at a project here that hasn't even been drilled that is potentially worth half the market cap of this stock. The Unga project in Alaska, I mean, I suppose if they wanted to stop advancing it, they could probably put in a mine right now and start producing gold. It's got a historic resource on it, and it's high grade gold. So, and then they've got two other silver projects down in Mexico, and each one of those in and of themselves could be company makers. So, if you think about what kind of gold mine could be modeled at the Unga project in Alaska, you're probably looking at something that could probably be built to produce 80 to 100,000 ounces a year, and that in this market that gets a $200 million market cap, especially high grade gold in a very friendly jurisdiction. So I love Heliostar. I mean, I love it now more at these prices than I did the last time we talked about it, but I mean, the whole sector is way down since we last chatted. Second one that I really like is, did you look at the I-80
I did not.
transaction that they did with
Equinox Gold and Premier and that whole situation?
Well, yeah, I-80 is a spin-off of assets from
with Ewan Downing
from Premier. Pardon
me? Ewing Downing, is that who's running that company?
That's the guy who's running I-80. Yeah.
Okay.
Well, he just did a deal with Newmont where he's taking over one of their it's an autoclave, and in Nevada with these Carlin and Cortez Trend projects, the high sulfide underground resource, you've got open pit, and then below you've got high sulfide underground gold resource. That stuff has to be oxidized before it can be processed and the gold extracted. And there's only 3 facilities in Nevada that do that, and there's a shortage. So there's a shortage of these autoclaves and roasters there. And Eric Sprott owned one of them, and he's Jarrett Canyon, and he sold that to First Majestic. That was a brilliant transaction. And Nevada Gold Mines owned the other 2. Well, they just did an asset swap with I-80 Gold, and now I-80 Gold owns this autoclave, and it needs to be upgraded. But I mean, talk about having a cartel on gold production in Nevada. That's what these autoclaves give you, because I chatted with someone about this well over a year ago, and I wrote about it extensively in my mining stock journal. And I think that's part of the reason why Carlin Trend Juniors kind of lag in price versus their peers in other jurisdictions, because everyone knows that, yeah, they're showing projects with great grades at the open pit, but then the underground stuff can't be processed. You have to wait in line at a processor. I mean, essentially Barrick and Newmont had a monopoly on, and Eric Sprott had a monopoly on the processing capacity for the sulfide, the sulfide ore that comes out of these mines. And so the guy I spoke to about this, he said, well, no one really talks about it, but it's there. I mean, Bay Street and Wall Street aren't going to talk about it because it makes it harder to sell the stocks in these junior companies. But he said he doesn't think the state of Nevada would ever permit another autoclave or roaster because of the environmental concerns. And he said it would cost at least $1 billion to build one. So I think this transaction, immediately puts I-80 into a league that there's very few gold miners in Nevada are in. And so I actually did a profile on the company who's the issue before this latest one. So if your audience wants to, they can read about it if they subscribe, because when someone subscribes, I give them, about 3 months worth of back issues. And 3 months, because that's what I do in each issue is companies that I cover and recommend and invest in. And I also, talk about companies that I would avoid. But usually there's been news flow from all the companies that I cover over a 3-month period. And so you can get a feel for, just looking at the welcome email and the back issues, what I look at, how I look at it, and, why I look at these companies.
And they can do that at investmentresearchdynamics.com, right?
Yes.
All right. And Dave also has a blog there, so go check that out. Dave, I really appreciate your macro outlook and gold, and you gave a lot of ideas here for investors to think about. So thank you for coming on the show again today.
Guess we went a little bit longer than we intended.
Hey, but everybody will enjoy it. So thank you.
Thank you, Bill.